If you ever looked at your mutual fund returns and seen two different numbers, a CAGR and an XIRR, and wondered why they're not the same, you're not alone. I always had the same question. Though we are traders, but that doesn't mean we don't invest. Moving profits from trading to something less risky, a mutual fund, an ETF, makes complete sense. And as someone who genuinely enjoys passive investing, tracking fund returns is something of a hobby to me. So a few weeks ago, I was reading a piece by Satya Sontanam from the Zerodha Varsity team that compared two small cap funds. One had a higher CAGR, but an SIP investor in the lower CAGR fund ended up with significantly more money. How did that happen? The reason comes down to what each number actually measures. CAGR looks at 2 points, where you started and where you ended. XIRR, on the other hand, looks at every single cash flow on every specific date. For a lump sum investor, that difference doesn't matter. For a SIP investor, it can completely change the picture. And most of us are somewhere in between. We add funds over time, not all at once. Reading that piece made me wonder where these two ideas actually came from and sent me down a rabbit hole I wasn't expecting. The story starts with cattle. You see, the oldest word for interest in Sumerian, in ancient Greek, in ancient Egyptian comes from the word for livestock. And the very first mental model for money earning more money was based on a herd. You lend your neighbor 10 cows, a year later you expect 11 back. The calf is the interest. That's where it begins. From there, the story takes a very long route. It passes through medieval Florence, where compound interest was banned by the Catholic Church and merchants had to disguise it as trading profits. It then passes through a Franciscan friar in Venice who happened to be Leonardo da Vinci's mathematics teacher. And then over a century, 3 mathematicians worked on it to build the algorithm that makes one of these two numbers actually work. And it ends with a small, forgotten software company in Cambridge, Massachusetts that built the Excel function in 1993 and made XIRR a part of every mutual fund statement in the world. And then the company vanished from history entirely. I'm Sandeep Rao, and this is the story of CAGR and XIRR. Two key ideas and more than 1,000 years of math behind them. Before getting to the backstory of these concepts, it's important to understand what they actually are and why they matter. CAGR, or CAGR, compounded annual growth rate, answers the question: you invested 1 lakh in a mutual fund 5 years ago as a lump sum, what did it grow to and how much did it return? So CAGR tells you the average annual rate of return across those 5 years. One number, 2 points in time. XIRR solves a very different problem. The X in the XIRR stands for extended. So XIRR is the extended internal rate of return. It's built for situations where the investment is not a single lump sum where you are putting in different amounts at different points in time. The amount can vary a fair bit. Month 1, you put in 5,000 rupees, month 2, 10,000, month 3, 2,000. The timing can vary too. You invest in month 1, skip 2 months, and then nothing for 6 months after that. And withdrawals are a part of the picture as well. You redeem 15,000 in month 8, that can also be factored in. XIRR handles both what goes in and what comes out and still gives you a clean annualized return number. When the amount, the timing, and the direction of the cash flows are all irregular, XIRR is the only way to measure returns accurately. But if both the amount and the timing were fixed, same sum, same interval, and no withdrawals, we'd use something called IRR, and we'll come to that. But for now, this distinction is what matters. Also, generally speaking, the CAGR helps us evaluate the fund manager's performance, and XIRR helps us evaluate the performance of the funds for the investor's cash flow. Both serve two very different purposes. If you want to understand how to compare these two values, I'll add a link in the show notes to the Varsity post. We We talked about cattle in the intro. Let me go a little deeper. Around 2000 BC, that is around 4000 years back, a Babylonian scribe carved a problem on a clay tablet. That tablet, written in cuneiform, the wedge-shaped script of ancient Mesopotamia in the Akkadian language, today sits at the Louvre in Paris. More interestingly, it poses a question. A 20% interest per year, and how long does it take for the loan to double? The answer carved into the clay, 3 years and 283 days. The scribe was wrong by 5 days. The correct answer is 3 years and 288 days. But what is remarkable is not the error, but the fact that someone 4000 years ago was already computing compound interest precisely enough to be wrong just by 5 days. At the same time, for most of the ancient and medieval history, it was also deeply controversial. The Catholic Church banned charging of interest entirely. Not just high interest, any interest. They called it usury, and it was a sin. The logic was largely theological. Money, unlike cattle, cannot naturally reproduce. Charging for its use over time was seen as profiting from time itself, and time belonged only to God. But trade and commerce won't stop because the church disapproves. So merchants found workarounds. They disguised interest as trading profits, and they structured loans as annuities. The mathematicians, meanwhile, were formalizing all of this. In 1202, Leonardo Fibonacci of Pisa published Liber Abaci. The book's primary contribution to Europe was introducing Hindu-Arabic numerals, the 0 through 9 positional system we use today. This changed everything. The Roman numerals cannot be multiplied or divided at any real scale. You cannot do compound interest calculations with X's and V's. The Hindu-Arabic system made precise financial arithmetic possible for the first time for ordinary merchants across Europe. And Fibonacci immediately used it for exactly that. Liber Abaci contains detailed calculation of compound interest and annuity valuations written with the same rigor you would find in a modern-day finance textbook. So if I really have to think about it, in a way, he was doing DCF analysis way back in 13th century. And moving on, in 1494, a Franciscan friar named Luca Pacioli published Summa di Arithmetica in Venice. Pacioli is best known as the father of double-entry bookkeeping, but in the same book, he gave us the rule of 72. Divide 72 by the interest rate to find out how long your money takes to double. At 6%, your money doubles in 12 years. It is an approximation, but a remarkably good one. Pacioli, incidentally, was Leonardo da Vinci's mathematics teacher as well. By 1613, a London-based practitioner named Richard Witt published the first comprehensive practical handbook on compound interest in England. Arithmetical questions. It had a table to calculate present values, annuity prices, and loan repayments without having to do the working by hand. Then in 1683, Jacob Bernoulli asked what happens if interest compounds not once a year but continuously at every instance. That question led him to the number 2.718, which Euler later named E, one of the most fundamental constants in all of mathematics. By this time, the concept of compound interest was taken to its logical extreme and became the number that shows up everywhere today, from population growth rates to quantum mechanics. On a side note, look up about the Bernoulli family and their contribution to mathematics. It's mind-blowing. So yes, by the late 17th century, the mathematics of compounding was essentially complete. But it remained for the next 2 centuries largely a specialist tool, the domain of merchants, bankers, and actuaries who needed it professionally. That changed in the 20th century. As industrialization created broader wealth and as investing moved from private bankers to wealthy families to ordinary people through the mutual fund industry, the question of how to measure and compare fund manager performance became important. Peter Bernstein, in the book Capital Ideas, his definitive history of how academic finance transformed Wall Street, documents this shift. From the 1950s onwards, driven by Markowitz, Sharpe, and Farmer, finance became rigorously quantitative. If you were going to compare fund A with fund B, you needed a common metric. That common metric was the geometric mean of annual returns, in other words, CAGR or CAGR. A fund with 12% CAGR over 5 years could be directly compared with one with a 12% CAGR over 7 years, or a fund in a different country or a different asset class as well. The compounding assumption was built in and time periods were normalized. And the number was simple enough for a retail investor to read and understand. From a Babylonian clay tablet to your mutual fund fact sheet, that is 4,000 years of accumulated thinking, and CAGR is where it landed. So we've spoken about CAGR, now moving on to the second idea of the day, XIRR. The story of XIRR is equally fascinating, but it is nowhere near as old. While CAGR's root go back to ancient Mesopotamia, XIRR as a concept barely touches a few hundred years. Developed primarily by two British actuaries who were solving it for bonds, annuities and pension valuations long before anyone called it a rate of return. The mathematical engine that makes the calculation was built by three mathematicians across 17th and 18th century. I'm sure none of whom would have the faintest idea they were building something that would one day sit inside a calculator or a spreadsheet as a function. That is the story we will get to now. You see, to understand XIRR, we need to understand the two components within it. The first one is the Newton-Raphson method, a mathematical calculus-driven engine which sits inside the XIRR calculation, which has its own history to it. The second is the IRR part of it, which is the math to calculate the annualized percentage rate at which an investment breaks even. XIRR is the marriage of the two. Note that both IRR and XIRR in reality can be calculated using trial and error or linear interpolation. You would pick two discount rates that bracketed 0 NPV, compute the NPV at each from pre-printed interest tables, and interpolate between them to find the rate. Applying Newton-Raphson fully by hand, iterating it 5, 6, 7 times until it converges requires computing 1 plus I to the power of n and its derivative at each step. By hand, doing that for complex cash flows is extremely laborious. So before computing, practitioners mostly used simpler interpolation methods, not because they didn't know about calculus-based methods, but because full iterative Newton-Raphson was impractical at scale without a machine. The first personal device to implement Newton-Raphson with genuine mathematical rigor was HP 92 printing calculator in the year 1977. Built on algorithms developed by Professor William Kahn of UC Berkeley. Earlier, HP financial calculators used iterative methods but with borderline accuracy. What really changed things was the iconic financial calculator HP 12C in 1981. It's HP's longest and the best-selling product to date. It was known as the Wall Street's cult calculator. But even HP 12C could only do IRR and not XIRR the way it works today. Now let's start with understanding the mathematical engine inside XIRR, that is the Newton-Raphson method, for which we need to go back to 1671. And we need a problem to start with. Fair warning, this may get a tad bit complex, but stay with me. The XIRR calculation has to do one thing, that is to find the rate of return which makes all your cash flows, every investment, every withdrawal on every specific date balance out to 0. Simple enough to say but impossible to solve directly. The equation has a separate exponent for each date in your data. You can't just rearrange it and land on an answer the way you would in school-level algebra. The equation is too tangled, too non-linear. So instead, you have to guess. You plug in a rate and see how far off the result is, adjust your guesses and try again. Each attempt gets you closer. You keep going until the answer stops meaningfully changing. This is called an iterative method, solving by repeated approximation rather than direct calculation. And the man who described it was Isaac Newton. Newton never published this in a manuscript. It sat in his private papers for 65 years and then appeared in print only in 1736, 9 years after his death. In the meantime, in 1690, a London-based mathematician named Joseph Raphson independently published the same method in a book called Analysis Equationum Universalis. Raphson published it 46 years before Newton's version ever appeared in print. And Raphson's version was by most accounts cleaner. Where Newton's approach recomputed a new equation at each step, Raphson kept the same equation and simply extracted successive corrections from it, more practical, more elegant, easier to apply by hand. The method that XIRR uses today is more Raphson than Newton, and yet it is called Newton-Raphson method with Newton's name first. After Raphson died, Newton apparently took control of his posthumous manuscript and added material to support his own side in the priority dispute over the invention of calculus. That's a big rabbit hole by itself, and I will leave it at that. There's one more thing worth knowing about Raphson. In a separate philosophical work published in 1697, he coined the word that is still in use today: pantheism. What a man indeed. Back to Newton. But Newton and Raphson alone weren't enough. Their method only worked on certain types of equations, the neat, well-behaved ones. XIRR's equation isn't neat. It's messy and irregular. That's where Thomas Simpson comes in the year 1740. Simpson borrowed a tool from calculus that told the method something crucial. Not just whether your guess was wrong, but exactly which direction to move and by how much. That one addition transformed guessing into something far more precise. Each attempt now had a precise mathematical guidance behind it. Without Simpson's contribution, the method is a bit like a person throwing darts in a dark room. But with his contribution, it's a bit like someone turning the lights on. That calculus-powered version is what actually runs inside Excel when you use XIRR. It's what makes the answer trustworthy and accurate. Just that Simpson never got his name on it. So now we know where the calculus-driven engine comes from. But to know how the chassis of XIRR, which is IRR, was built, we need to take a minor detour. We are now back to the year 1556. An Italian mathematician named Tartaglia recorded a real case from the port city of Bari, where a merchant gave a university 2,814 ducats and was to be paid back 618 ducats a year for 9 years. Now the question is, what rate of return was the merchant earning? There was no algebraic answer and calculus did not exist then. The only way to approach it was pure trial and error, and there it stayed an unsolved problem for over a century. The first genuine analytical solution came in 1677 from a little-known British writer named Michael Derry, who published an iterative theorem of finding the yield on an annuity. His method converged slowly, but it was the first. What followed was nearly 3 centuries of British actuaries refining it. Francis Bailey in 1808, George Barrett in 1811, Ralph Todd Hunter in 1897, and several others, all publishing in the Journal of the Institute of Actuaries. These were people calculating pension valuations, life annuity prices, and bond yields. The problem they were solving is mathematically identical to what we call IRR today. The term, though, didn't exist at that point of time. But you see, the actuaries were always asking a backwards question. Given this price and these cash flows, what yield does it produce? Nobody yet had turned it around and asked the forward question. Given what I am paying today, is the investment worth making at all? This is where Fisher comes in. Now, sometime in the 1930s, a Yale economist by the name Irving Fisher published a book called The Theory of Interest. In it, he described something he called the rate of return over cost, the annual return at which your investment exactly pays for itself. Say you buy a piece of equipment for 10 lakhs and it generates 2.5 lakhs in revenue or cash flow every year. That's 25% of your invested capital annually. On the face of it, you might call this a 25% return per annum. But can you say that the asset pays for itself in 4 years? Well, no, we cannot. The 2.5 lakh you receive in year 1 is not the same as the 2.5 lakh you receive in year 4. The one arriving later is worth less in today's money because money in hand today can be deployed and earns returns, whereas money arriving later sits idle until it arrives. So you simply cannot multiply 2.5 lakhs by 4 years and call it even. This is where Fisher's concept comes in. When you account for the reducing value of future cash flows and calculate the true annualized return, the rate at which the investment actually pays for itself, the number is not 25%. It would take 6 years of 2.5 lakh annual returns for the IRR to work out to approximately 13%, and that is the real return. The gap between 4 and 6 years is precisely what Fisher was trying to capture. The investment looks like it pays back in 4 years on paper, but in real return terms, accounting for what your money could have earned elsewhere in the meantime, it takes 6 years. The true annual return over those 6 years is 13% and not 25%. Fisher described this mathematically. He didn't call it IRR though, but the concept was identical. It took another 2 decades for someone to bring it into practice. In 1951, a Columbia Business School economist named Joel Dean published Capital Budgeting, a book that became the standard reference for how corporations should evaluate investments. Dean took Fisher's concept, named it the internal rate of return. For the first time, a company could compare a factory expansion, an acquisition, and a new product line on a single number. IRR became the language of capital allocation. But IRR had a hidden assumption baked into it. It assumed that every cash flow arrived at perfectly equal intervals, every month, every quarter, every year, but real investing doesn't work that way. A company raises money in March, buys equipment in September, earns revenue in February. An investor puts in money this month, skips 3 months, adds more, then redeems partially. IRR was blind to actual calendar dates. All it knew was period 1, period 2, period 3. If your periods weren't equal, your IRR goes awry. This is the problem XIRR was built to solve. In other words, IRR for the real world, where cash flows land on specific dates in irregular amounts in any direction. While the solution to solve irregular cash flows in a way existed in the actuarial world, it wasn't yet accessible to the world of finance. Now, someone had to put the calculus and the IRR math together in an easy-to-use way, and that's what XIRR managed to accomplish. Now, the year is 1993, and we are talking about Microsoft Excel. You see, Excel itself was launched on September 30th, 1985, originally for the Mac and for Windows 2 years later in 1987. By 1993, Microsoft had released Excel 5.0, and bundled with it was an analysis tool pack add-in. The tool pack was built by a small company called Grey Matter International Incorporate based in Cambridge, Massachusetts, a fact confirmed in the official Microsoft Excel 5.0 User's Guide, where they're credited by name. That is the only place their name appears. No record of what happened to them after. If you do, please share in the comments. Now, while we do not know the exact circumstances under which XIRR was invented, who exactly were the minds behind creating the XIRR formula, it definitely appeared for the first time in the analysis tool pack, a plugin on top of Microsoft Excel. And here is what makes it special. XIRR doesn't just copy IRR's math. It extends and makes it better as it takes actual calendar dates into consideration. Every cash flow you enter is converted to an exact number of days from the first date. Instead of period 1, period 2, period 3, it works with day 0, day 47, day 183, day 291, you name it. The cash flow is discounted by exactly how many days it sits from the start. This is why XIRR needs actual dates as input, not just amounts. That is the leap IRR could not make. Things changed in 2007 when Microsoft released Excel 2007 and promoted XIRR from an optional add-in to a native built-in function by default with no activation required. That is the moment when XIRR truly became public. That's just about 2 decades back. Today, we live in the world of AI, and while spreadsheets may or may not be around forever, who knows, XIRR still runs exactly the same way it did. With Newton's math, Raphson's refinement, and Simpson's generalization, all of it embedded in that XIRR number every time you look at your investment returns. So yes, that brings me to the end of this episode. We looked at 2 seemingly mundane metrics: CAGR that carries 4,000 years of thinking from a clay tablet in Babylon through medieval Florence, through Fibonacci's arithmetic and Bernoulli's discovery of the E, distilled into one annual growth rate that tells you how a fund performed. And XIRR, which carries close to 400 years of actuarial calculations, Newton's unpublished manuscript, Raphson's cleaner solution, Simpson's calculus, and the work of a forgotten company in Cambridge, all converging into one number that tells you how your investment performed in that fund. In reality, the fund's performance and your investment performance both matter. And now you know exactly where they come from. I hope you found this episode useful. If you have any questions, feel free to drop them in the comments. I'll be happy to respond. Till then, take care and trade safe, and I will be back soon with the next one.